What's up, everybody? This is Sunko, the Korean bro. Today is 2022, November 29th. Today is Tuesday, and it's been long since I did YouTube last time, so I felt like I really wanted to do YouTube live, so I turned it on. Uh, let's see what we have. Hmm. First, what I'm gonna do is look at economic calendar. And what events do we have from the United States? Let's see. On November 29th, so Tuesday, so today, we have CB consumer confidence. It's not really important. And on November 30th, which is tomorrow, we'll have crude oil inventories, pending home sales, job openings, GDP, ADP, non-farm employment change. On Thursday, December 1st, we'll have initial jobless claims, core PCE price index. Okay. So we'll wait and see. Tomorrow is important day. Today is not as important as tomorrow, so we'll look at the events tomorrow, and let's see investing articles. Okay. Let's go through articles from mollyfool.com. Two super stocks down 51%, 65% to buy before they rebound. Here's my top value stock to buy right now. Big Oil is betting big money on this renewable fuel. Two growth stocks that could soar 1,000% in the next 10 years. 5 ways to generate income in retirement without going back to work. Two growth stocks down 68%, 76% to buy hand over fist. Let's read these first. And let's go to yahoofinance.com and look at general mood that's been going on these days. Okay. First, two super stocks down 51%, 65%. Bill.com grew its revenue by whopping 94% in the most recent quarter, balking the economic weakness. DigitalOcean's cloud business is outgrowing the cloud business of both Amazon and Microsoft right now. Shares of both companies are beaten down, but could be set for a strong rebound in the new year. We have Bill.com. It's something that I don't know. I have to read, otherwise I will never know. Okay. The S&P 500 index has lost over 15% year to date, and if the year ended right now, it will be the worst result since 2008 when the global financial crisis rocked the world. But there are some early signs that inflation has peaked, which could ease the pressure on consumers and businesses alike. Yeah, obviously, at this point, we have a lot of signs that signify that inflation is peaking, and in any time it could ease the pressure on consumers and businesses alike. So With 2023 right around the corner, that's sets the stage for a potential rebound in the market. And here are two stocks worth buying while they are still trading at a discount. Okay. Let's see. Bill.com. Okay. In a tough economic environment where consumer spending is constrained, small businesses are often the first to suffer, and so they tend to invest less money in growth and general improvements. But Bill.com continues to experience robust demand for its payment software, which streamlines the accounts payable and accounts receivable workflows, in addition to budgeting and expense management. For its payment software, uh, so what Bill.com mainly does is they make account systems uh, work well. Let's look at price level of Bill.com first. Bill.com. Bill.com Holdings. Mm, its current price level is 115.61. Its all-time high was 318.17. Let's go to profile. Its full-time employees are 2,269. Here's description. It provides cloud-based software that simplifies, digitizes, and automates back office financial operations for small and mid-sized business worldwide. The company provides software as a service, SaaS, cloud-based payments and spend management products, which allow users to automate accounts payable and accounts receivable transactions, as well as enable users to connect it with their suppliers and customers to do business, eliminate expense reports, manage cash flows, and improve office efficiency. It also offers an onboarding implementation support, ongoing support, and training services. So their main customers are small and mid-sized businesses, and what they do is they make um, tedious finance work much easier by providing them software that they can use. Mm. And their main program is a cloud-based payment software. Okay, get it. And what's their advantage here? Its a flagship digital inbox is designed to eliminate massive paper trails by allowing businesses to upload all of their incoming invoices into one central location. So their method in terms of making finance system easier is by allowing businesses to upload all of their incoming invoices into one central location. Okay. From there, the platform allows bills to be paid with a single click. It also logs each transaction the business choice of bookkeeping software. Okay. Mm, Okay. Okay, and it continues. It accomplishes is using cloud computing technology, which makes Bill.com's tools available from anywhere at any time. Okay. In the recent first quarter of fiscal 2023, the company served 420,000 business customers. Okay, it's currently processing transactions at an annual run rate of $250 billion. While Bill.com's revenue has slowed, it still grew by a whopping 94% year over year during quarter first. It also reported a net retention rate of 131%, which means its existing customers are spending 31% more each year with the company. That indicative of how useful Bill.com tools are. Despite challenging economic conditions, businesses are still increasing their speed. Why? Besides the company's rapid growth, Wall Street is extremely bullish. All of the 24 analysts tracked by the Wall Street Journal, 22 of them have given the stock the highest possible buy rating. The other two are neutral, and not a single one recommends selling. Hmm, okay, let's get back to summary. And its revenue is exponentially growing. Uh, whereas its earnings is, hmm, they don't earn money yet. They don't have much profit. But since a lot of analysts from Wall Street is expects that their revenue could grow anytime soon, and only two are neutral, and no one from the Wall Street says they would sell this stock. Mm. They are giving it the highest possible buy rating. Okay. But I don't know much about this area, so I'll have to consider buying it. Not really buying, but like I'll have to look at it in depth. Okay, let's go to DigitalOcean. DigitalOcean's cloud business is beating Amazon and Microsoft for growth. It's not exactly an apples to apples comparison between DigitalOcean. Is valued at just $2.7 billion, whereas Amazon and Microsoft are trillion-dollar giants. But cloud computing has been the star performer for both Amazon and Microsoft for several years. In the recent third quarter, DigitalOcean had them bid for growth. DigitalOcean, DOCN. Its ticker is DOCN. Let's go to price level. Mm. Its revenue is growing, and its price level is 27.75, and on in year 2021 November 19, its all-time high was 128.53. Okay. It's not exactly an episode comparison. Okay. Mm. But cloud computing has been the star performer for both Amazon and Microsoft for several years. In the recent third quarter, DigitalOcean had them bid for growth. Okay. DigitalOcean has carved out a lucrative niche in the fast-growing cloud services industry. It targets small to mid-sized enterprises, which often fall through the cracks of larger providers like Amazon Web Services and Microsoft Azure. Those smaller operations need personalized service, cheap pricing, and easy-to-use tools because they don't have the budget to retain highly paid technical staff. DigitalOcean delivers all of that and more, including an online library filled with thousands of education resources to help customers get the most out of their cloud experience. Whether they are using simple data storage, deploying virtual machines, or building complex software. And they appear to love the platform because DigitalOcean's net retention rate hit a record high of 118% in quarter third, meaning existing customers are spending 18% more each year with the company. Mm, okay. So uh, they have their own niche uh, in the fast growing cloud service industry. And unlike Microsoft Azure and Amazon Web Service, since they have their own niche, they know what they have to offer. And in quarter third, they're beating both companies. Hmm. And plus, they know what they have to offer. So they provide a lot of services or like a lot of information that customers can use. Hmm. and they let a customer experience cloud environment as much as they can. Mm, okay. DigitalOcean's revenue soared by 37% year over year to $152 million, crushing AWS and Microsoft's intelligent cloud segment. It also reported a record high average revenue per user, the record number of customers spending at least $50 per month. Okay. This might be a great opportunity to buy ahead of what should be more favorable new year. Uh, I'll have to read this article in depth. I just cannot buy this just because um just by just reading sources from this article. hmm hmm Okay. Let's get to the next one. Here's my top value stock to buy right now. Despite higher interest rates, housing demand will remain strong because of tight inventory and housing storage. Leonard looks well priced at P&E of less than 6. Home building sector. Why? After 2 years of surging home prices, suddenly the market is worried about a crash in the housing market. Okay, with mortgage rates rising fast, home prices already stretched, and fears of recession sweeping the market, the pieces seem to be in place for a pullback in home prices. That exactly applies to situation that's happening in Korea. A lot of price of home is decreasing, mm, and people who lives at those homes are worried about paying loans. Its interest rate is increasing rapidly, and um, it's not their choice, but like they gotta pay it someday, and like it's what they have to pay is increasing rapidly, so that's pretty disastrous. Okay, despite the beginning of a decline in home prices, the U.S. still has a national housing shortage as home builders pulled back in home construction in the decade following the housing crisis. And as of 2019, the U.S. had a shortage of 3.8 million homes, according to the Freddie Mac. Home builder stocks have fallen over the last year. Um, Fear of a new housing bubble, but the housing shortage should help support long-term demand in the sector. That's one reason to give Lennar, one of the nation's biggest home builders, and a top value stock to buy right now. A closer look. Hmm. So the reason this author says home building sector company is what we have to buy because at this point people are worried about housing bubble, so its price went down these days, but then uh, housing shortage will help us support long-term demand in the sector. So at the end, the price level of land will go up. That's the point of his opinion. Mm. CEO Stuart Miller also expressed long-term optimism about demand even in the face of rising interest rates, saying sales have clearly been impacted by rising interest rates, but there remains a significant national shortage of housing, especially workforce housing, and demand remains strong as we navigate the rebounds between price and interest rates. Mm, okay. While the home building sector down across the board this year, there are already signs they could recover over the coming year, especially if the Fed pivot or an end to rising interest rates comes sooner than expected. When the October Consumer Price Index reading came in lower than expected on November 10, home builder stocks surged. Hmm, it's too difficult. I don't know much about home building industry, so uh let's get to the next one. The first we have is Upstart Holdings, and the next one is Riskyfied. Okay, Riskyfied. Okay, let's do Upstart first. Banks rely heavily on FICO scores. Yes, when making lending decisions, but those three-digit credit scores are based on a relatively limited number of variables. That creates problems. Some applicants are wrongfully rejected, while others are charged too much interest to cover the losses from borrowers that never should have been approved. Offshore wants to make the system more efficient. Its lending platform uses artificial intelligence to measure more than 1,500 data points per borrower, about 100 for modern traditional credit models to help lenders quantify risk more precisely. According to management, Offshore's AI models separate high risk borrowers from low risk borrowers with 5 times more precision than vehicle based models. Mm, mm. So, okay, let's briefly summarize what he's trying to say here. So, Upstart, the company, uses a AI system, and what they do is instead of using a FICO scores, they use AI to measure 1,500 data points per borrower. So they separate high risk borrowers from low risk borrowers with 5 times more precision. So AI system is much more precise than the traditional one. Hmm. Okay. Unfortunately, the current economic environment has been a serious obstacle for the company. Banks are less willing to extend credit to consumers battling high inflation, and consumers are less interested in taking on debt with interest rates on the rise. To that end, Upstart saw revenue plunge 31% to $157 million in the third quarter, a dramatic turnaround from 250%. Okay. Hmm. Although they have that advantage that I mentioned earlier, because of a recession that's been going on these days, um, they're struggling, right? But here it is. Worse yet, they're a young fintech company, uh, and its AI platform has yet to be tested through a down period in the credit cycle. That creates an additional headwind. Lenders are even less likely to abandon familiar, familiar FICO-based credit models for new technology meet the current environment. That has Wall Street feeling particularly bearish and Wall upside at the present time. Mm-hmm. That also creates an opportunity for long-term investors based on landing data from the past 4 years. Hmm. Opster can quantify risk far more effectively than vehicle-based models, meaning its AI platform can lower uh, loss rates for lenders. If that superiority persists through the current downturn, offshore will likely see adoption soar as the economy rebounds. Okay. With that in mind, Upstart currently powers personal loans, auto loans, and small business loans, which puts its total addressable market in the neighborhood of a $1.5 trillion. But that figure is poised to grow as the company continues to expand into new lending verticals. Okay. Hmm. Okay, let's get to the next one. Riskify, AI-powered risk management. Riskify operates an AI-powered risk management platform. Its software helps online business boost approval rates and prevent fraud at checkout, which translate into higher revenue and lower fraud-related operating expenses. In fact, the 10 largest Riskify merchants have reported an 8% uptick in sales and a 39% decrease in chargeable chargeback cost. Of course, Riskify faces competition from other payment service providers like PayPal and MasterCard, but its platform integrates more deeply with its merchants infrastructure that gives Riskify the data advantage, which theoretically makes its AI engine better at correlating consumer behavior patterns with the risk of fraud. The company reported encouraging financial results in the third quarter. Revenue increased 22% to $63 million, and its GAAP loss narrowed to $0.15 per share. Looking ahead, Riskify could see tremendous growth in the coming years as its AI platform addresses a serious problem. Uh, okay. I don't know what kind of fraud exists in online business, but by using their system, one can mm, help their business well. Oh, AI powered risk management. Okay. And here it says false declines will cost merchants at $720 billion in 2022, and fraud will cost $25 billion by 2024. Mm. Yeah, Riskified has hardly scratched the surface of its total addressable market. This year, the company will handle about $100 billion in gross merchants volume, but global e-commerce sales will total $5.7 trillion. Put another way, Riskified has captured less than 2% of a large and growing TAM. Hmm. Okay. Riskified, Riskified, Upstart Holdings, and Riskified. Riskified. Hmm. What makes Riskified a new buy stock? From Zacks.com. Riskified could be a solid addition to your portfolio given its recent upgrade to a Zacks rank number 2. This rating change essentially reflects an upward trend in earning estimates. Most powerful force impacting stock prices. Unlike the overall optimistic Wall Street analysts whose rating system tend to be weighted toward a favorable recommendation, the Zacks rating system maintains equal. Uh, okay, let's go to next article. It's not really. It doesn't really gives me an idea. HubSpot is the market leader in customer relationship management software among small businesses. HubSpot. Okay. Mm. Global e-health business expanding into international markets, and its partnership with Shopify could be a significant tailwind. Global e. Okay, HubSpot, the second best global software company. HubSpot specializes in customer relationship management. Its platform includes productivity software for marketing, sales, and customer service, as well as solutions for content management, data management, and payments. Those tools help businesses attract visitors with personalized web experiences, convert visitors into buyers with effective sales support, mm, and maintain those buyer relationships with delightful customer service. HubSpot targets small and medium-sized businesses and underserved segments of the CRM industry, and its freemium pricing strategy and broad CRM suite have propelled the company to the top of the market. Mm, okay. According to research company G2, HubSpot is the CRM leader in the small business niche. It ranks as the second best global software company in 2022 based on market presence and user satisfaction. HubSpot, okay, HubSpot. HubSpot. Hmm. Okay. Hmm. HubSpot. Okay. HubSpot. HubSpot reported a strong financial results in the third quarter, despite the tough economic climate. Revenue climbed 31% to $444 million, and non-GAAP earnings climbed 38% to $0.69 per diluted share. Okay. Looking ahead, HubSpot is well positioned for future growth. Uh, The company puts its addressable market at $72 billion by 2027. And its track record for continuous product innovation should keep HubSpot on the leading edge of the CRM industry. Mm. Okay, continuous product innovation. For instance, the company has added a significant number of commerce capabilities to its platform since launching native payments last year. Mm. HubSpot. Okay, let's go to profile. Mm. HubSpot.com. Powerful, not overpowering. CRM platform that's both powerful and easy to use. Create delightful customer experience. Have a delightful time doing it. Okay. Your whole business will love. Okay. CRM. To grow, but you have to be ruthless. But we know there's a better way to grow. One where what's good for the bottom line is also good for your customers. We believe business can grow with a conscious and succeed with a soul. They can do it with inbound. Mm. Mm. Okay. Anyway, HubSpot. Okay. And we have a global e-sales, cross-border e-commerce made easy. Growing a business in the domestic market is hard enough, but expanding into international markets can be very difficult. Yes. Merchants have to be tackle different languages, currencies, and consumer preferences, and they have to navigate legal complexities like taxes and customs. This is where Global E can make a difference. Global E helps merchants optimize their digital storefronts for international markets. Its platform localizes details like language, currency, and payment options, and it connects sellers with shipping carriers, provides after-sales support, handles the calculation and remittance of import duties and foreign taxes. In a nutshell, Global E simplifies cross-border commerce in over 200 destination markets around the world, helping merchants better connect with international buyers. The ultimate results in higher conversion rates. Okay. Global e-sales. Global e-sales. Global e-sales. Global e-sales. Global e-online. Global e-online. Okay. Um, hmm. Interesting. Hmm. Global e-online. Global E help merchants optimize their digital storefronts for international markets. Its platform localizes details like language, currency, and payment options. It connects sellers with shipping carriers, provides after sales support, and handles the calculation and remittance of import duties and foreign taxes. Industrial Global E simplifies cross border commerce in over 200 destination markets around the world, helping merchants better connect with international buyers. That ultimately results in higher conversion rates. Hmm. Global E is growing like wildfire. Revenue soared 79% to $106 million in the third quarter, a particularly impressive metric given the state of the economy. The said Global E is still losing money, reported a GAAP loss of $0.41 per share in the third quarter. And management lowered fourth quarter guidance due to unfavorable foreign exchange rates. Hmm. Given the state of the economy, it's losing money, but its revenue is increasing. Oh, okay. Yeah, but yeah, fortunately, those headwinds are temporary. Hmm. Okay. And what else we have? And the long-term investment thesis is still sound. Cross-border e-commerce sales are expected to grow at nearly 26% per year to reach 5.6 trillion by 2030. What we know is that from 2018 to 2021, its revenue is increasing. On 2021, its earnings went down drastically. I don't know what causes it, but probably for some investment purpose or like you know making some products. I don't know. And let's see. That puts a global in front of a massive market opportunity. Okay, and the company has several tailwinds working in its favor. So although they have a lot of tailwinds like currency rate and like interest rates, its headwind is temporary. So after a while or a year later, their revenue can possibly grow exponentially. Mm. Okay, let's keep on reading. Most notably, Global E is the exclusive third-party provider of cross-border solutions to Shopify merchants, and Shopify is the most popular e-commerce software on the market. I myself also invested in the company named Shopify, and the good thing about this company is that they have relationship with Shopify and global e-commerce, which is really good because Shopify is like one of the leading company in e-commerce industry. So okay, that's about it. Global e online. I'll have to see if I want to really invest in this company because I don't know much about it yet. But like, uh, what they do really helps merchants to do international sales smoothly. So I'll have to consider a while later. And the next website that I'm going to look at is marketbeat.com. Mm, let's see, what interesting articles do we have here? Mm, we have an article about Zoom video. Let's read this one first. Okay. Let's see. Revenue growth has fallen from a blinding 350% during the pandemic to just under 5% in quarter third 2022. First, let's look at price level of Zoom.com. Mm, It's been a while since I saw chart of Zoom last time. So current price is 71.59. Its all-time high was 559. Okay. And let's look at key points here. Zoom trades at 19 times forward earnings with a 7.3% short interest. And the strong US dollar cut top line revenue growth to 5% from a 7% in constant currency. Investors fear a continued slowdown in growth as outlook is muted as Zoom continues to cut estimates. Mm, Ever since I bought this company, its price has been going down, but I know for sure that it's gonna go up someday. Mm, what I know is that on December 5th, we'll have another event about interest rates. And on that day, we'll see what's gonna happen. And that event will have a big impact on stock market, possibly because of that its price level is going down. Hmm. Let's look at first three sentences or four sentences in this article. Zoom video has gone from an obscure but easy to use video communications platform to becoming a verb synonymous with video conferencing and remote engagement driven by the COVID-19 pandemic. Yeah, for sure. In COVID-19 period, its price um, went up so fast. But then in this year, people feel that COVID is disappearing soon. Because of that, its price went down again. Because as people are cured, people will get along with other people more often, and in that way, people will use less Zoom video communications. So anyway, Zoom video was one of the major benefactors of the pandemic, that helped assure in the new normal of hybrid work in a post-pandemic world. So, like, working trend has also changed. Um, Before COVID-19, people went to office and it was one way of working. But then after COVID, people work. Um, the pattern of work has changed. People work at home and office, and they go back and forth. Anyway, yeah, while other video calling tools were available, Zoom's incredibly easy interface brought video conferencing to the mainstream masses. Yes, the company's growth has since peaked as normalization continues to set in. The question is where the baseline is for Zoom and what catalyst can help is speed growth back up. Mm. Mm. But the problem is they have a lot of competitors, so we'll still have to see what they can offer because they have competitors like uh, Google, because Google also offers this kind of system. But it's good to know that they have a lot of collaboration software companies like Adobe, Microsoft Teams, Salesforce, Cisco WebEx meetings. Since they can work with a lot of big companies, they got a lot of opportunities ahead. So anyway, that's it with mollyfool.com and marketbeat.com. And mm, that's it for today because I feel like I want to finish it tonight. And for tomorrow or the day after tomorrow, I'll talk about some of the companies that I invested in recently, and we'll see. Okay, bye bye.